I will have this available on all of your favorite podcast platforms under the Lead Lag Live banner soon enough. My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is Bob Elliott of Unlimited Funds. Bob, for those who are not familiar with your background, introduce yourself. Who are you? Talk about your career. How'd you get interested in markets, and what are you doing today?
Yeah, for sure. Happy to do that. Good morning, everyone. My background is really 20 years as a systematic investor. I was at Bridgewater Associates for almost 15 years, where I was on the investment committee, senior executive, built investment strategies across all the major asset classes, and including many that were used in the flagship Pure Alpha Fund. After leaving Bridgewater, I did a tour through the private side of the 2 and 20 world, running a $125 million venture capital book that systematically identified high potential early stage consumer opportunities. So systemization, systematic investing on the private side. And then after a little while in that space, sort of increasingly recognized that the world of 2 and 20 is pretty good for the manager and pretty bad for the investor, given the fees that are charged and the inefficient tax structures. And so that inspired me to think about whether there was a way to bring diversified, low-cost index investing to the world of 2 and 20. And that's what Unlimited is all about, which is using technology to infer what asset managers are doing in the 2 and 20 space, and then putting that understanding together to construct diversified, low-cost index ETFs that track the index returns of 2 and 20 managers at a much lower fee structure and more tax efficient structure.
All right, let's focus on the term systematic for a moment in the context of your career at Bridgewater and how you actually run your fund and your approach. I don't know if many people really understand what systematic actually means. People find it hard to distinguish between systematic and discretionary. Let's distinguish the two for the audience, and then get into how you actually replicate those 2 and 20 types of strategies.
Yeah, for sure. I mean, what systematic means for most systematic investors is what you're doing is you're creating a set of decision rules that you use to determine what your positions are at any point in time. Those decision rules can be based upon a number of different things. They can be based upon, at Bridgewater, for instance, when I was developing proprietary investment strategies, it was a set of, cause effect drivers that drove asset markets. You can have those decision rules based, be differences in allocating between asset classes. You can use them, a systematic approach at individual stock level all the way up to a portfolio level. So there's lots of different ways to build a systematic investment strategy. But ultimately, what it really means is using decision rules to manage your day-to-day investing. And I think, systemization is particularly valuable, I think, in times like this, where it can be pretty tough to maintain a sense of equanimity as we go through these sorts of ups and downs in the financial markets. And so it's something I wrote about a couple of weeks ago. I think systematic investors are going to have a much better time navigating through these sorts of markets and dynamics, because the key to success in these sorts of dynamics is have something that has edge, which systematic investors typically can sort of assess and evaluate whether they have a strategy that has edge, and then have the discipline to manage to that strategy without getting distracted by these sort of ups and downs and the day-to-day noise that's going on. And so when there is a lot of day-to-day noise and a lot of volatility, systemization is really critical to have that discipline to navigate through these sorts of environments.
Yeah, and that discipline is an edge over the long term. Of course, that doesn't, as you know, mean that you're necessarily going to do particularly well if the cycle is against you. But at least if you're systematic, you've taken out the human element, which can throw off, a way of allocating. Part of being systematic, though, is also backtesting. Talk about, from your experience, how important, or maybe not as important, backtesting is for investors when they think about putting together a portfolio of assets or trading around a particular set of signals?
Yeah, I think unless you've built a systematic back-tested assessment of whether or not your strategy is effective, it's hard to know what we often call goodness. It's hard to know the goodness of any intuition or decision rule. And I think having spent 20 years building a wide range of proprietary investment strategies, I think you'd be surprised at how often things that seem sort of intuitively obvious in one form or another, often when you go back and take that intuition and you test it, across different time horizons or across different markets or countries, how you quickly learn that those intuitions are not that great at actually trading markets through time. I like to say that a good systematic investor, their idea generation is a lot like being a hitter in baseball. You're gonna bat on your intuitions like 200-300 in terms of trading markets when you go back and test it, and that's pretty good because if you can find 10, 20 of those different strategies that from a universe of ideas that you create over time, and you go back and test them and you assess them and you build them in a good portfolio, you can get edge. You can get that 55-45 edge or that 60-40 edge. And if you can get that 60-40 edge, you can be a heck of a asset manager over time. But it really starts with the intuition translated to the decision rule, translated to the back test of whether or not that works over time, which then gives you the confidence on a forward-looking basis to manage using those decision rules. I all the time talk to people who think, frankly, that their intuition or their discretion is really good, and the truth of the matter is, it is very hard over short periods of time to differentiate your intuition or a person's intuition between luck and skill. And it's much easier with higher sample size to differentiate the two. And systemization and backtesting is just a way, basically, to understand more effectively whether what is happening is luck or is it skill.
So you hit on something which has always been something I myself have stressed multiple times over the years, which is that the reality is there are really very few predictors when it comes to investing, right? So I've backtested thousands of different signals across thousands of different securities. I'm very cynical of most things that people argue have predictive power, because when you actually test it, as much as it sounds, to your point, logical and intuitive, it tends to not actually pan out when you actually create a rules-based approach around it. And I'm always of the belief that if you're going to have a strategy, if it can't be back tested, what's the point? Because exactly like you said, there's going to be a degree of luck and skill. And if you're going to be more based on luck because you can't test the skill, you're going to find yourself in trouble at some point. I'm curious, in your work, is there anything that you've seen over time that has sort of a consistent underlying thread as far as what makes something predictive? So talking from my own vantage point, these different research studies that won these different awards back to 2014 that document utilities against the market, lumber to gold, treasuries, moving average, everything in my world in some way, shape, or form is related to interest rates. That if you can tell sort of where the demand for money is changing, that might show you the whites of the eyes of regime change to come in volatility. Is there any sort of common thread that you've seen that makes a particular strategy that's back-tested valid versus not?
Well, I think the main thing over my career that I've learned is that strategies that can be described in a straightforward way are often and are systematized or tested in a non-optimized, very robust way, typically look a little worse in the back testing and perform a lot better in the forward testing. I think that's a big thing, and that there's a lot of edge. Typically, even relatively straightforward ideas have a lot of edge if they can be done in a disciplined manner with high diversification. And so the real issue is, don't over optimize that solution. I think it's a really important thing Don't over optimize your solution, particularly when you're trying to test something in the back history. I think the other thing that I've found successful over time, this may feel a little generic, which is just you got to get down to the motivations of why people are doing what they're doing. That's the basic, that's the basic thing. And the motivations of how people respond, I think in general can be thought of. They are both complex, but at some level you can extract, the 80-20 across those motivations, whether it's, whether someone's decision to buy a house, right? There's probably five basic decisions, five basic things that describe why they might buy a house, or a company's earnings dynamics. It's probably five or six core things in an 80-20 way capture what's driving those earnings dynamics. And so what you can do is you can understand those dynamics, write them down, test them, put them together, diversify across a high sample size. If you do all that, you're going to get some edge. And that's really what this is all about, like a modest edge, well diversified across a large sample size will get you to success. And that's what I see when I look at the most sophisticated asset managers in the world. That's what they do, is that they have a bunch of diversified positions in aggregate. The best ones have a lot of diversified positions. Each one of them is, a bit better than 50-50. And together, that creates a pretty reasonable chance of a pretty good outcome, which I think is very different than, I was writing about this earlier this week. Like a lot of people today are just betting on, are effectively in one form or another, just betting on, is the Fed going to pivot or not? Or is the Fed going to have tighter monetary policy relative to expectations or not? And that's like one bet. It is, at best 60-40, maybe 55-40, probably more like 55-45, given the uncertainty of the overall, macro dynamic. And, if you get it right or wrong, one bet, it could be luck, it could be skill. Much better to build a diversified portfolio where you have 10 or 20 of those bets that all are kind of have a little bit of edge to them. And, you do a little bit better on the upside than the downside, and you'll be okay. It'll be a little boring, but it'll be okay.
They're also betting through the lens of recency bias and small sample bias, right? I mean, you lose this idea that you need to have a large sample size to see if any strategy or backtest has validity, so that you can factor in multiple cycles. And I've used that line many times on the road, that we live in the small sample, right? So this year, the first time in history where treasuries have lost more money than equities. The risk off has done worse than the risk on side. You do any kind of back test going back to 1961, you wouldn't see that. Even in the 70s, it's not just a function of the kind of post-Volcker world. So that lends to a question of, from a systematic perspective, do you think about optimizing when you're in a small sample where it looks like whatever cause and effect that you've relied on is broken in the here and now? My response would be, you can't over optimize or chase optimization. And actually your own comments around find the back test, which is maybe slightly worse than you might hope, because going forward it might be better. But I want to hear your thoughts on, what do you do when you're in a small sample where what you've developed simply is not working for whatever reason?
Well, I think one of the key things is to consistently be not just with your direction of your view, but your confidence, and navigating or adjusting your confidence based upon the uncertainty in the markets that you see. I think one of the things when I look at, both having developed proprietary strategies, but also today basically observing, and I think the thing that's so interesting to see is, like, hedge funds deliver much better returns, certainly on a risk-adjusted basis and a little bit on an outright basis, than index investing. The way they do it is not that glorious in aggregate, in the sense of what they do is they limit downside risk in periods of uncertainty, and then they deliver a moderately good return during upside periods. And so and I think it's a good, and you put that together over time, actually, for a number of different reasons, because you don't have as much vol drag as a typical index investment, is you end up getting a much more consistent return stream in something that it really is advantageous in a portfolio relative to index investing, assuming you don't pay 2 and 20 fees if you can pay much more reasonable fees and taxes on it. And so I think what that highlights is a big part of the quality of the return of those managers is basically saying there are periods of time where you're not really sure, or there are periods of time where there's heightened volatility. And those are the times not to take a yo on a particular position. Those are the times to cut your risk, acknowledge that there is uncertainty or unknown, and frankly be quite conservative. And so I think that's part of the, and today actually what we see is, using our technology, is we see that hedge funds are running essentially the lowest leverage that they have in a non-crisis period in the last 25 years, because there is so much uncertainty. And so I think that's basically, if you think about the quality of a systematic process, it's important to think about what's the direction of views, what's your confidence that those views are going to be successful at any point in time, and combine those two things together in order to, prudently navigate through the dynamic. I don't know if that's helpful.
No, for sure. And that lends to sort of a good offshoot question, I think, which is that how should one think about complexity when it comes to developing a strategy or doing anything that's systematic, right? Is it better to be simple, or is it better to have as many variables as possible that might explain the way the world works from what you've researched?
I mean, my experience, I should say, is that the thing that the complexity does not mean accuracy. Like, it really doesn't. And I think often people see the concept of complexity connected with sophistication, and that if you've been around the block a few times and been through the ups and the downs and seen the over-optimized solutions versus, let's call it, the under-optimized solutions, what you see over time is that in many ways, systematic, common sense, unoptimized, well-diversified strategies, when you put that set of things together, what you get is a much more reliable over time outcome than something that is, complicated, concentrated, discretionary. All of those things just generally lead to much less reliable outcomes over time. It can be hard to see at any point in time, right? Because, luck is a big part of the experience, right? I don't know, if you started your strategy 10 years ago or something like that, you'd have a different experience of luck than starting 20 years ago or 30 years ago. You'd have a different experience of luck in the first 10 years than if you started today, or you started it a year ago or 2 years ago. And so I think people often forget just how much luck plays a role. And so that's why I often say, don't necessarily look at the outcomes. The outcomes are valuable to look at, but look at the process. And the process is going to help you understand whether something is likely to be successful in the future or not. And look at that process, particularly through time, backtesting and things like that are valuable in order to see whether that process, how good is that process at generating a good return over time, and particularly in the context of, is that process optimized or under-optimized? If it's under-optimized, tests pretty well through time, through a number of different market cycles, and is commonsensical, then it probably will be pretty good, and is diversified. It will probably lead to a pretty good outcome in the future. That's kind of what you're looking for, is a bunch of those things.
Yeah, and I've used that line before. It's, amateurs look to the right of the equal sign, which is the outcome, right? And pros look to the left, which is the process. And I like that point you mentioned, which is that there's a degree of luck in terms of when you launch a particular approach or strategy. If Ray Dalio had started the entire risk parity concept at January 1st of this year compared to however number of years ago he started it, this year has been terrible for risk parity, right? And that's hard to really kind of get people to wrap their minds around, right? Because when you're manufacturing products, you're creating strategies, trying to do something different. You can't necessarily control that easily when you launch, if it happens to be in a cycle that doesn't favor your approach. And it's hard to counter narratives around what you've developed if it just so happens you launch a particular approach in the exact wrong cycle. Now, I'm going to relate that to hedge funds here. I'm sure you've seen a lot of these studies, Bob, that point to this idea that alpha really has largely gone away post GFC for the hedge fund community. What do you attribute that broad dynamic to? And could it simply just be as simple as saying, if you don't have the 2 and 20, there's still alpha?
Well, I think that the biggest issue here is if you look through time, hedge fund strategies, I say strategies before you start talking about fees and stuff like that, hedge fund strategies are very good. That makes sense, right? That makes intuitive sense. Like you've got the most sophisticated investors in the world at the most sophisticated institutions spending billions of dollars to essentially mine for alpha and then put that on in the most disciplined ways possible. And would you intuitively think that those folks beat the market? Yeah, you would intuitively think that. And the reality is that they do beat the market, both on a top line basis and on a Sharpe ratio basis. The big issue for most investors is a couple things. One is that the fees are too damn high, right? So even though the strategies are great, like the only people who are, it's making the manager rich and making the investor not so rich when the manager takes all the alpha away in fees. Yeah, another issue, which is that they're often in tax disadvantaged structures. So you have for a taxable investor, they're typically in LP positions. Those are typically at ordinary income, and that's not very, that's pretty bad for the everyday investors. And then the last thing, which is such a critical part, is that the experienced outcome for most investors is also a lot worse than what you see in the index, because the best, most sophisticated firms are typically closed, right? Unless you've got, hundreds of millions of dollars or billions of dollars these days, you can't get into a top 10 firm. And many of them are closed and not even letting anyone in. And so you have terrible negative selection bias. And so I think that's kind of, if you take away those things, if you can track all the funds instead of just the ones that are open, if you can make them, make the exposure more tax efficient, and if you can charge less fees, you put that all back together and you actually get a return stream that most investors would feel pretty good about having in their portfolio. Stock like orders of magnitude, stock like returns, stock index like returns, half the volatility, moderately correlated to a traditional 60-40 portfolio. Like that's a pretty good return stream. That's kind of what you want. And the problem is all of those implementation issues that exist that haven't been, in the past haven't been solved all that well.
Right. And that then led to a discussion around the role of interest rates in whether a cycle favors active versus passive, right? Active more on the hedge fund side, passive more on the cheap beta side. I'm going to make the argument, correct me if I'm wrong, that zero interest rate policy makes it all about beta, and the way you generate alpha is just by leveraging beta, which is really kind of counter to the very definition of alpha. But as you're in a more prolonged inflationary cycle, Bob, you think that you will see more alpha coming out of hedge funds, out of alternative strategies, because now the cost of capital actually means something? Let's relate the idea of alpha to interest rates here.
Yeah, I think part of when you go through a period of 15 years of unbridled monetary stimulation, you get a dynamic where basically index investing looks smart because it's cheap and it's easy to do. And levered index investing looks the smartest because, you're getting high nominal returns. Now, I think even during this period, smart people recognize that, levered beta is levered beta. Smart evaluators recognize that. So I think that was probably less of a big driver of how people were evaluating things. But you have this basic dynamic where it's hard to make the case for alpha when beta is doing so well. And beta does well in periods of monetary stimulation. All beta is just a bet between cash and assets. And for 15 years, what the Fed was doing was basically trying to make cash garbage. I heard there's a guy once who said cash is trash, right? That's that was true for 15 years. But and so in that period, because beta is a bet on cash versus assets, or assets versus cash, beta does very well. When you get to a point where, in many ways, purposefully, the Fed is saying, I want assets to be bad relative to cash. I want cash to be strong relative to assets. You have a circumstance where beta is going to be bad because that's literally what the Fed wants. And so that creates a real opportunity for alpha. And I think this period, in many ways, is going to be one of the most opportunistic periods for alpha, one of the best periods for alpha that we're going to see, because not only is it a period where beta is doing worse than cash by intention by the Fed, but also it's a period that is so outside the norms that investors have in terms of their experiential norms, that it requires a real level of sophistication that the sort of hedge fund type community has in order to navigate through these dynamics. And so, you look at the market today, like the hedge fund index in aggregate before fees is down, 4 or 5 on the year through October. Well, that beats the pants off of 60, 40, basically anything other than maybe if you were lucky and either held cash through the period exclusively or, made a concentrated bet in commodities. But other than that, against basically every normal portfolio that's out there, hedge funds have killed it because they've been able to navigate through this dynamic where beta is underperforming in a much, much more effective way. I bet, 95%, 98% of the people who are maybe listening here or out there in the world would be happy as clams to have collected their, down 4 or 5% for the year rather than where they sit today.
Let me reset the room for the remaining hour here. Everybody, please make sure you follow Bob Elliott. And if you are curious, check out his ETF as well. Again, this will be a podcast on all your favorite platforms under the Lead Lag Live banner. Okay, so we've got heightened inflation. There's a sense that it's going to last for a while. We're in some kind of new regime. I tend to be cynical of narratives, Bob. It's different until it's not, right? How do you think about the current cycle that we're in? There was a lot of excitement around the CPI data that came out last week. Seems like we're in some kind of a melt-up, which I've been arguing likely would be the case starting October 2nd, given sentiment and these other quant indicators that I track. But I want to hear your take on where we are in the cycle and how to put together a proper portfolio. Because the reality is, as you kind of alluded to, unless you had a concentrated bet in commodities, there really has been nowhere to run. And shorting is not an asset class.
Yeah, I think I'll start with the narrative, and then you can get down to the nuts and bolts of it. I think for a long time, I taught a intro macro markets class to all the incoming investors at Bridgewater, and each year we'd sit down and I'd review the dynamics of an inflationary cycle. They would all look at all the kids straight out of school would look at me and they'd sort of say, "Why are we learning this stuff? This isn't how cycles work anymore. Cycles haven't worked like this in 50 years." And I'd say, well, there'll be a day. There'll be a day when you care about this. And, probably it's sooner rather than later. And so in a lot of ways, I think back to those various conversations. I think how valuable the study of traditional inflationary cycles are to understanding what's going on right now. I think it's a big reason why macro funds, as an example, have done so well, which is it has been so typical in terms of an inflationary cycle. And so when you think about it in that context, where we are is that the economy is running hot in a level perspective. It's cooled in a growth perspective basis, but it's run pretty hot in a level basis. Labor market's about as tight as it can be. Capacity utilization and production is about as tight as it can be. Wages are growing quite rapidly. All of those things are going on, all indicative of relatively tight aggregate economy from a level perspective. And then what we're seeing is the typical response to that, which is a tightening dynamic, which the Fed finally got around to doing a little late in the game on it. And so we're kind of, we're 6 months into a tightening in response to a typical inflationary cycle. And that often is, that is reasonably early days in terms of the cycle, right? And so when you see what eventually creates the meaningful turn in an inflationary cycle, what it takes is you have to have enough tightening of the economy in order to get us, typically through asset prices, enough of a fall of asset prices to create enough of a slowing of demand, to create enough of a deterioration in earnings, to create a weakening of the labor market, which then creates a weakening of wages, which flows back and weakens demand. And typically what it takes is after a big tightening wave, it takes, 12 to 18 months to get the labor market down. And it takes another 12-ish months beyond that to start to get to a point where inflation finally really meaningfully comes down. We've gone on inflation. We were, in the 8 or 9 range. We're now a little lower than that, but we're not anywhere near where the Fed wants to go. And so that's the basic picture. Is if you look through that dynamic, like macro cycles are pretty boring. They take a long time. The lead lags take a long time, and we're kind of early days in that whole cycle to get to a point where inflation is down enough so that the Fed can take the foot off the brake. Underneath those sorts of dynamics, there's always this push-pull, which is the waves of expectations that everything's okay to the waves that it's going to be a disaster, to the waves it's okay, to the waves that it's a disaster. Almost all cycles see those things. You see 20% moves up and down in stocks. It's a very normal dynamic. More people who have long experiences in these cycles and are disciplined about how they operate often use those opportunities to basically add a little alpha as you're going across, as you're going down in a broader dynamic, adding a little alpha along the way, whether you get, long when things get oversold or short, a little more short when things are overbought. And so that's kind of, in that cycle, what we're in basically an overbought subcycle amongst a big, a downward trend that's taking a long time to get there. And so that's kind of where I see it. I think from me as an investor, and if you read what my stuff is, because I traded so much as an institutional manager that honestly couldn't, that took time. Big institutional managers take time to move in and out of positions. I'm always sort of thinking about the next 6 or 9 months when I'm thinking about what's going on in the markets rather than necessarily the next week or two. But, there are dynamics that are, that's not the time frame of every investor. And so, you do see these waves, these sort of these bullish, over bullish waves and over bearish waves. And we're probably, 75% through an over bullish wave in a longer downward cycle here. I don't know if that answered exactly what you were asking for.
Yeah, no, that's good. But you mentioned something which is I think important to think through, which is that if you're going to look at any kind of historical analysis, you have some rough time frame of the lags with which something permeates through the markets and through the economy. You mentioned 12 to 18 months. The thing is, we've never had a cycle where interest rates move this fast. So, and where I think where the narrative is so entrenched in terms of higher for longer, and the Fed has to keep on quote unquote playing catch up. So I see that myself, and I wonder if that means that the lags would be more compressed. Obviously, it takes time for interest rates to filter through to the economy, and to break inflation takes time, but it may be a faster transmission mechanism than before.
On the macro side, I think it's probably, I would take the over on people's intuition about how long these cycles take. And I think a big part of that is because most people's experience is trading is in 2020, which was a cycle that I think, was like 6 weeks, basically. And 2008, which, you had a little bit of a peaked in September, August 2007, but really was acute starting in September 2008 and then bottomed in March 2009. Like, I think that's the cycle that people have in their heads. And they think that that's how the macro cycle works. Those are crisis market cycles, not macro market cycles. macro market cycles take a very long time. So just as an example, if you go back to the 2000 dynamic, which is not exactly analogous, but it kind of gives you a sense. There was kind of a bubble in everything, or a bubble in tech, which popped and permeated through the economy. Today, we kind of have more of a bubble in everything, or had a bubble in everything that's sort of the tightening's permeating through the economy. And I think what you see there is, it basically took 3 years from the stock market to peak. The stock market literally bottomed in 2002, but then got darn close to the bottom again in 2003. It took about 3 years for that whole cycle to work out, which was very much a macroeconomic cycle. And it was one, it was that's what it takes to get all the different pieces together. It took a year to weaken the labor market, a little bit longer. It took another period of time to finally get inflation down. It took a while for the Fed kept the money tight for a while, and then eased. And it took, about 18 months for that easing eventually to get to a bottoming of the stock market, persistent bottoming of the stock market, to then reignite the cycle over time. And so those things take a very long time. And if anything, what I'd say is that the macro sensitivity, there's been a huge shift in the structure of the economy to help de-risk the economy to rises in interest rates, as the 15 years of monetary stimulation was absorbed into the market, allowing many participants to refinance at very low rates for a long time, and corporations to push out the debt that's due. And so there's not a lot of immediate sensitivity in the economy to the rise in interest rates. Like, I was looking at a chart from Goldman, and you say, how much have household, mortgage expenses risen since the beginning of the year? And the answer is essentially zero, right? Because the mortgage rates just rose, and which is very different in the rest of the world, which is probably a distraction to talk about now, but it's very different in the rest of the world. And it just is a simple example of the fact that, interest rates are up 500 basis points, or will be up 500 basis points relatively soon. But does it even matter? Where does it really matter? Where it's really mattered is valuations in very long dated securities like tech companies and loss-making tech companies. Where it matters is on the margin if you're trying to get a mortgage, but it doesn't really matter that much in the day-to-day of people going about their daily lives. It really doesn't affect them all that much. And I think that's a really important thing to keep in mind when you're thinking about just how long and slow this whole process is going to go.
No, I think that's an important point. It's the incremental activity, right? Not the prior activity, which is locked in. And, oftentimes it's the rollover of the debt at higher rates that matters the most for a crisis dynamic, right? So unless you get a juncture in time where there's a large number of junk issuers suddenly having to roll over the debt at double or triple their prior interest rate, they're still paying, to your point, the prior rate. So it's not really impacting them that much. So from that perspective, I think there's a lot of logic to the idea that this will take time because there's a lot of legacy low rates to expire, I guess, so to speak.
Yeah, I mean, all that liquidity built up over 15 years of unbridled monetary stimulation. It's going to take a while. It's kind of sitting in all the various corners, and we almost don't even know everywhere where it's sitting, in all sorts of explicit, implicit ways that makes it, that it keeps the sensitivity low and the cycle going, whether it's the fiscal stimulation that's still in the bank accounts that can be spent, or it's the low interest rates that everyone's locked in and things like that, or the high cash that's on the sidelines. Those are the things that really slow the slow cycle is a dividend, so to speak, of the 15 years of monetary stimulation, even though the last 6 or 9 months have been, the fastest pace of tightening in that most people have experienced in their professional lives. Now, it's nothing compared to, Paul Volcker raised interest rates, 1,300 basis points in 5 months. That's a tightening.
I want to hear your thoughts on currency for a moment. I shared at the Nest tweet you put out about the shift from a dollar surge to maybe dollar weakening. I've been on that kick for the last month and a half. The traditional narrative is a strong dollar is disinflationary, a weak dollar is inflationary. So Now, if you end up having a potential weaker dollar, well, that's going to add more fuel to the inflation fire. How do you think through the dollar's movement and this inflationary cycle dynamic, and relate that also to the alternative space? Because from everything that I've seen, a lot of these managed futures strategies in particular, which have really done well this year, really were just long dollar plays.
Yeah, I think the big deal, the core synthesis of does the dollar matter or does it not matter in the macro perspective, the big picture from the U.S. perspective is by and large the dollar doesn't matter that much. That's the big picture. Doesn't really affect what the Fed's doing. It has a modest effect on companies and their earnings perspective, but that's the big picture sense. I think you go a level below and you can start to add up, and that's what I did in this tweet because I was actually someone asked a question about, and I was like, well, it's a kind of high time to figure out exactly, to try and quantify these things, and we basically had the best dollar year since the 80s, and what it worked out to was putting an 0.6% drag on inflation relative to what it would have been otherwise, given the normal sensitivities and stuff like that. And that's shifting from a 0.6% drag to probably a couple tenths positive. And so, on a change basis, that's probably maybe, let's call it 1% inflationary pressure on CPI, from comparing the backward looking to the forward looking, which is, something. It is what it is. It's 1%. Other things have certain impacts, but it probably is more impactful, honestly. I mean, it is more impactful for earnings, where typically the flow through, just as a rule of thumb, is about for every 1% move in DXY, you get an 0.5% drag on earnings. So, what's that add up to? About a 10% drag, give or take, in earnings. And we actually saw a fair amount of that impact of the currency effect in earnings in this past quarter set of announcements. That's certainly interesting when you think about how far we've gone in this cycle. And I know I've highlighted this repeatedly, but if you think about the underlying dynamics in the stock market, right? What are stocks down this year, give or take? Okay, we're at down 17 or 18%. Well, just the discounting effect is should be giving a discounting effect. It depends on exactly how you think about it, but maybe it's 20%, maybe it's 30%, depending on how you look at it. So, that's interesting. So stocks are down 17%. You'd expect, based on just the rise in the interest rates, that they'd be down between 20 and 30%. And then just because of the DXY move, you'd expect it to be down another 10%. Stocks are pretty high in the scheme of things relative to those two sizable pressures that are in the market, and if anything, are probably look. Some people have highlighted this in the last day or two. Stocks today, or stocks at 4,000 or whatever, something equivalent to that, given the interest rate rise and the dollar rise, look a lot worse today than they did at 4,800 before this decline, given where interest rates were and the dollar was. So I think it's more of a stocks story. The dollar and is more of a stock story than it is a inflation story.
Yeah, that's a fair point. But I always go back to the most people's reference for the stock market's the S&P. The average stock has lost a lot more than the S&P, as you know. So you can maybe argue that we're kind of in line with what one might expect if you look beyond the market cap heavy FANG type of names that have all now broken down. I've used that line before as the generals fall, the soldiers rise, given some of the breadth that's improved here. I want to go back for a moment. Again, everybody here, please make sure you follow Bob Elliott here on Twitter. I want to go back to your experience in the VC side. So I was going through your stream as you were talking. Shared in the Nest, this tweet you put out, institutional investors are going to learn a lot of lessons from this first blizzard of the coming venture winter. And that term winter is interesting because you often hear that term winter when it comes to the crypto space, crypto winter. Talk about venture capital cycles for a moment, because I'm going to assume that what we've seen in the crypto space is more of a sign of a bigger problem, perhaps, with cheap money and how venture capital use that cheap money for things that are now blown up.
Yeah, I mean, I think if you take a step back, venture capital basically invests in assets that are negative profit for a very, very long period of time. And so who basically, in order to realize the value, the eventual possible value, is you need to borrow a lot along the way. And in order to achieve a high valuation, you need to have very, very low interest rates so that very, very long dated cash flows are, much lower discounted in order to basically, in order to make the case that those companies have high value in the future, high present value. And so that's, venture capital is the most extreme of that whole set of things in terms of the most extreme. Venture capital investing is the most extreme in terms of investing in companies that are negative profitability in the short term and maybe we'll see some profits in the future. And those companies are the most reliant on easy liquidity to sustain. And so what we're seeing is frankly the inevitable consequence of the tightening of liquidity. Not that much tightening liquidity in the scheme of things, right? Not that much tightening, because if you're a boring company with a boring balance sheet making boring profits, you got plenty of access to capital. It's just a little more expensive than it was before. But these, what I like to say is the sort of garbage tech companies, that their reckoning is here. And if you think about it actually from the lead lag perspective, most of those companies, their equity valuations peaked in February 2021. They really got cut off at the beginning of the year, and they're only now starting to fail, which is interesting when you think about like how long does this whole cycle play out. We're only now starting to see some moderate layoffs of those garbage unprofitable tech companies that were venture financed, and that's 18 plus months since the peak of their equity valuation. And so I think the thing that we're going to see is this reckoning. Like if you look at the venture capital index, the Cambridge Associates one as an example, like it's down 10% from peak, which is crazy, totally implausible when you have publicly traded loss-making tech companies down 80%. And then you sit here and you say your venture book is down 10%. And let me tell you, I've been in that world. I know exactly how the thing works. Everyone can spin a yarn about why their company isn't down as much as the market. And let me tell you, they know, a lot of that business is spinning yarns about how great the companies are, even though when you look at the underlying situation, you say, well, look, they're losing tons of money. It's questionable whether they'll be successful. And so, that's what we're really going to see. And institutional investors like bet the farm on these assets for so long, whether it's private equity or venture capital, thinking that this was going to be the way out, as if they could game the system, that what they see in the public markets, will magically not exist in the private markets. But it's not the way the world works. And so, we're gonna see a whole bunch of venture-backed companies fail, and we're gonna see years of marking those assets down, and it's gonna be pretty ugly for a long time in the venture space. In the same way it was, the venture index, people forget, from 2000 to 2003 went down 75%. Given the way public markets are trading, given the way the world is today, that seems like a totally plausible outcome, and no institutional investor is even considering the fact that it could be down. Their venture book could be down 75%.
So I thought these guys were supposed to be the smartest guys in the room. Is it a function of the smart guys do dumb things? Is it a function of FOMO overtakes them, just like you see in the public markets? So why is it that you had so much chasing among the VC side with these companies that, just with a little bit of basic analysis, you'd say probably are not going to survive?
Well, I think, having sat on both the public side and the private side, I think there is nothing like public markets to humble an investor. Because even if you're very smart, every day there's basically a 50% chance that you're going to be humbled in terms of what your positions are. And I think what that creates is in general, amongst sophisticated investors in the public markets, a much more conservative, risk control focused perspective on the day to day, on investing, in a way that the feedback cycles in the private space, they're just so long. That's a big part. The feedback cycle is going to take 5 years before we really know who's invested in a good portfolio and who's invested in a bad portfolio, 5 or 10 years. And so I think that's a big difference in terms of the mindset between the investors and what transpires. And then I think the other thing is that there is, if you're an institutional investor investing in a hedge fund manager, for instance, you basically would never invest in a hedge fund manager if you didn't have a track record or a believable back test of what they're doing. Right? That's just like industry standard stuff. When you talk about the venture space, like, because the lag times are so long, because these investors wanted to get a lot of capital out into the venture business, what ends up happening is that they're investing based upon very, very, very limited information, and in particular, betting on things that are much more likely to be a function of luck rather than skill, given the concentration, given the sample size, given the timing, the time frames, that it's very, very hard to know whether what the outcomes are a matter of luck and skill. Even for me, I was focused in the early stage consumer space, which is really good because you have a lot of big data about every transaction, people buy at the Kroger and stuff like that. Even there, you didn't have that much sample size. You didn't have a decade of information. And even there, I could see in the space how investors responded to certain investors who, for instance, displayed confidence in their views, when if you went under the hood and you looked at the nuts and bolts of the numbers, you saw that it was totally wrong. But it's hard to hold people accountable when there is no demand for track record or no demand for simulation in order to assess whether it's luck or skill.
All right. So at the top of the hour here, again, everybody make sure you follow Bob Elliott. Bob, maybe kind of final thought from you as far as what makes for a successful systematic strategy or trader. You're tracking the stuff, you're trying to replicate from the 2 and 20 space. Are there certain things that for the retail audience they should consider factoring into their own portfolio construction to make them better from a longer term perspective that maybe the institutional players do and intuitively know?
Well, my biggest recommendation is to think about diversification. I think the best, even the best discretionary investors, will constantly be thinking and reflecting on the fact that the odds of any one bet is 60-40. And so you don't want to over lever into one particular set of assets or set of bets. And so that's why I think one of the things that I consistently am trying to find is what is that low or negatively correlated bet to the sort of general thesis that has like a nice convexity if the general thesis is wrong, and how do you sort of create a bunch of different bets that are all slightly weighted in your favor, because the odds that we're going to get one particular outcome right is not necessarily that high. And I think actually it's interesting when we look at what hedge fund managers, how they're positioned today. At any point when we look at them, they're basically, overall quite conservative given the volatility and the uncertainty in the market environment. But they're also positioned in a way to not be overweight one particular outcome versus another, in the sense of, you have modest longs in credit, conservative positions in equity, short positions in bonds, long positions in industrial and energy commodities, and long positions in gold. That's sort of in aggregate kind of what the positioning is, and a long position in the dollar. And if you add that all up, that basically is a pretty balanced portfolio to whether the Fed is easier relative to expectations or tighter relative to expectations. But each one of those underlying bets is probably a good bet on its own from a 60-40 perspective. And so what they do is they build a portfolio of these different assets or these different positions that is, modestly advantaged, and you put them all together and you should get a pretty decent, a pretty good probability of a decent return. Like that's what you're constantly trying to do if you're an institutional investor. And so, it's so easy as an individual to get, to look through the feed and get revved up on one bet or another, whether CPI is going to be higher or lower than expectations. And it's pretty inconsistent with what you see from sophisticated asset managers who frankly are trying to target a relatively boring outcome. The best institutional investors kind of meander up and to the right in a way that never really is all that exciting or volatile, right? They're just kind of meandering up there with this diversified portfolio of different bets over time.
Well, which basically sounds like a variation of risk parity in framework, which I very much agree with and know the research behind fairly well. Again, it's and the key term there is on average. You want a position for the boring because on average that's what tends to work best, right? But people get, I think, too focused on the small sample excitement and catalysts of the moment as opposed to the longer form research and data which goes into the various stuff that you're talking about. So I think that's absolutely worth mentioning. Everybody here again, please make sure you follow Bob Elliott. Great conversation, Bob. And everybody enjoy the rest of your day. Thank you, Bob.